Hello and welcome to Market Domination. I'm Julie Hyman. That's Josh Lipton, live from our New York City headquarters. We are giving you the ultimate investing playbook to help tune out the noise and make the right moves for your money.
And here's your headline blitz, getting you up to speed 1 hour before the closing bell rings on Wall Street.
We do believe that inflation trends down in the second half of the year. We think growth will also trend down in the second half of the year while remaining above trend. That's why we lean more towards that soft landing camp. But he just can't see a reacceleration. And I think that is what will really change his tone, reacceleration for a sustained period of time.
So very pleased with what we've done. You remember in the fall, we had said that we were restructuring the company to right-size it, especially manufacturing, because of the decrease of demand going from pandemic to endemic. And if you look at our Q1 expenses, including manufacturing, R&D, and sales and marketing, we're actually down $800 million compared to Q1 of 2023.
We're seeing the initial steps of having Gen AI happening on devices. We've talked a lot about Gen AI in cloud, but our vision is that eventually, just like processing happens on cloud and devices, Gen AI is also going to happen on cloud and devices. And so we're seeing the first steps of that happen in phones. We're going to start seeing that happen in PCs, in automotive, in IoT.
We've got 1 hour to go until the market close here. We're taking a look at the major indices sponsored by Tasty Trade. And we got stocks moving higher here. Let's check the major averages. Dow's up about 1%. S&P 500, your broad gauge, also up about 1%. Tech-heavy Nasdaq up about 1.5% here. Apple is helping today. The iPhone maker in the green, of course, reports results after the bell. And this is typically the quarter when Apple does update its capital return program. And those moves also coming, Julie, of course, as investors now react and respond to the Fed's decision yesterday, keep rates unchanged. And Jay Powell also remembers saying it's unlikely, in his words, an interest rate hike is their next move.
Let's talk more about that. The Federal Reserve outlook here. Of course, it kept interest rates unchanged on Wednesday, holding the Fed funds rate at a 23-year high. And while the expectations coming into the year were for multiple cuts, our first guest today did predict the Fed would hold steady for the full year. And so far, that has indeed been the case. Let's welcome in Torsten Slok, Apollo Global Management Chief Economist. We should note Apollo is also the parent company of Yahoo Finance. Good to see you. Thanks for coming in, Torsten. So indeed, amongst the sort of voices on the street, you were one of the very earliest that we noticed who said, we're not going to get cuts this year. Has anything changed in your view as we've heard? Are you pushing out maybe your outlook for cuts even more?
No, I still think that they will not cut rates this year. The reason is that after several years of the Fed saying interest rates are going up, 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 in December of last year, they changed their tone, and now, including even yesterday, we are now talking about rate cuts as the next move. So when the Fed began to change their tone, and instead of talking about interest rates going up, but now talk about interest rates going down, that unleashed a very significant amount of activity in capital markets. The S&P 500, where market cap is around 40 trillion, is up about 20% since the November FOMC meeting. That's about $8 trillion added in market value just because of the stock market going up. Remember, consumer spending last year was 19 trillion. So that means that roughly half of consumption has been added to household balance sheets. So with that backdrop, we changed our view when we saw that the tailwind from the gains in the stock market, from tighter credit spreads, from, generally speaking, lower interest rates, this has all been helping the economy. So we still think that the economy will be doing well for the next several quarters.
But does that also imply that the Fed made a mistake in its signaling? Because even though it has not yet cut rates, the signaling that it was going to maybe prolong the inflation cycle?
That's exactly what I think is most important about this discussion. I don't think this was their intention. I think that they just looked very innocently at the dual mandate that they have been given by Congress. Inflation should be 2%. We should have full employment. And they said, well, inflation is coming down. We're at full employment, so maybe we don't need to have interest rates so high anymore. That's why they began to talk about interest rates going down. But what they didn't recognize and maybe only realized later was that when you, after several years of having said interest rates are going up, 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 you did did not have many IPOs, you did not have much M&A activity, you didn't have much issuance in IG high yields. So as a result of that, that has now been unleashed, and that is, as we speak, creating much more activity in capital markets, much more consumer spending. That's why non-farm payrolls has been strong for the last 3 months. Inflation is reaccelerating. The consumer is still strong because we now have a significant tailwind because of that signal change. So I don't think this was their intention. I think this is just what happened, that it unleashed that significant tailwind to the economy that then is creating this risk of inflation moving higher again.
I'm interested, Torsten, then. So you don't see cuts this year. What is kind of the probabilities you put on a rate hike? Because yesterday Jay Powell says unlikely, but what do you see? What are the probabilities there?
So the Fed Fund futures market is saying there's a 20% chance of a rate hike this year. I think that's a reasonable number. So 80% that we will stay here, or in some people's scenario go lower, or 20% risk that we'll go higher. But I still think that we should definitely take 1 month at a time. The data tomorrow will be extremely important because this will be setting the stage for how we think about, will rate cuts come sooner, or might we have interest rates higher for longer? Because remember, interest rates higher for longer is not good for small cap. 40% of the Russell 2000 have negative earnings. And if you already have no earnings and you have higher and higher debt expenses, that runs the risk, of course, that small cap companies might be more under pressure. So there's a very important difference between the S&P and the Russell 2000 when you think about this implication of interest rates staying higher for longer.
And of course, the data you're referring to tomorrow is the jobs report. Do you think we will get any signs there that show that maybe unemployment is ticking up or wages are moderating to any degree?
Well, we saw today, as you also covered, of course, so well here, that the jobless claims numbers are still very low at around 200,000. In other words, there's still a limited amount of people who filed for unemployment claims last week for the first time. If you look at the consensus expectation is that job growth in the month of April will be 240,000. The unemployment rate expected to move sideways at 3.8. So in that sense, if we're waiting for a slowdown to get the Fed to begin to cut rates, that's not coming tomorrow. So that's why my best guess still is that we will still have to wait a while before the data begins to slow down, and therefore rates higher for longer continues to create particularly challenging environment on your screen of companies for those firms that have high leverage, that have low coverage ratios, meaning low earnings relative to interest expenses. So that means that the most highly levered companies, both in credit and in equity, are probably continue to be more challenged by interest rates simply not coming down.
I have kind of a broader question to you also, Torsten, just as someone who's watched the Fed for so long. You look at our central bankers. I mean, in 2021, they talked about transitory inflation. They were wrong. I think it's fair to say earlier this year, FOMC officials sounding pretty positive about the trajectory of inflation. Now, not so much. I'm just interested in the confidence you have in the Fed, the credibility.
No, I'm smiling here because if you go back, the Fed began with Ben Bernanke to produce their interest rate forecast in 2012. And if you go back and ask the question, how did it go with that forecast process? How successful were they? And the answer is they were basically wrong 90% of the time. They did not predict interest rates the right way. They were just saying, well, this is what we think will happen. Ooh, that's not what happens. Okay, then we'll do something else. So that's why when now they say, as we speak, their view is we will get 3 cuts this year. We might as well have a debate about, well, that's open for discussion because they have not been right for a very, very long time. The market hasn't been right either, but it's just to say the high conviction that we all have, and when we debate between FOMC meetings and we put so much emphasis on what they're saying, we should all, including they, be humble here that it is just a really difficult job for them. It's difficult for us in markets. So therefore, hanging our hats on their view, oh, we're getting 3 cuts this year, it could as well be correct that we may get no cuts.
And of course, a lot is riding on, on them trying to grapple with this and come up with the right answer. And the other thing I wanted to ask you about is you say, as you look at the screen of companies, those that have high leverage are going to still have to deal with this. We also seem to be maybe starting to see some erosion of consumer spending, at least if you look on the micro level and look at some of the company reports we've been getting.
Yeah.
Do you think that that's the case, and how worried are you about that? Do you think that's going to get worse?
I do think that this conversation about a K-shaped recovery where the lower income consumers are getting hit harder and harder, and why are they getting hit harder and harder? Because they generally tend to have more debt. That also happens to be younger households. When you're young, you have more debt on your house, you have more debt on your car, more debt on your credit card. So when interest rates go up, it's not surprising that younger and lower income households are actually hit harder as a result of the Fed raising rates. Whereas the upper leg of the K is people who have assets. If you have stocks, obviously have done quite well. Houses have done quite well. If you own fixed income, your cash flow in fixed income is probably the best that it's been in decades because the yield that you have both on normal rates, on private credit, on broadly speaking fixed income is just so high that this is exactly also supporting your balance sheet. And this continued move in the K, where some households are experiencing more distress as a result of the Fed having raised rates, and others are still experiencing stock prices going up and cash flow being good. I think that we will continue to see that development, which is exactly to your question, that the names that have been reporting for the last week or so have exactly been names that are catering to the lower-end income consumers and income groups who are more and more under pressure. McDonald's, others, where you have seen exactly these anecdotes that there is more selectiveness among consumers in terms of what they do. So the short answer to your question is, in the aggregate, consumption is actually still looking okay, but there is underneath the data some very important differences in some groups are doing better than others.
I'm interested towards you talk about those younger Americans, and they're going to be less likely to own a home as well. And we're talking to Zillow's CFO later in the show. What is your outlook for the housing market?
Well, the challenge, of course, was, and I know it gets slightly complicated when you think about what the Fed has been doing, but when interest rates went up, that meant that more and more people didn't move because they wanted to keep their low interest rate, their mortgage rate at 3%, and they didn't want to reset and get a new one at 6, 7, 8%. The consequence of that was that the inventory and the number of homes for sale, and you should ask the Zillow person you're going to talk to about this, basically came down dramatically. And when the inventory came down and we all came out of COVID and demand went up, then home prices actually have been going up. This week we got Case-Shiller now up 7%. Remember, in the CPI index, housing makes up about 40% of the basket. So in inflation, housing is really important because for the average consumer, 40% of their consumption goes towards paying either their mortgage or their rent. That means that in a somewhat perverse way, we have had that the Fed hiking rates has lowered the inventory of homes, which has actually pushed out home prices, which is actually now pushing up inflation. So that's why my textbook in economics would have said that that's not what should have happened, but that is exactly, unfortunately for the Fed, what happened, that we're now wrestling with that maybe inflation could actually take even longer, and maybe therefore the Fed may have, that's not our expectation, but to keep rates higher for longer, and the worst case, hike for more, to exactly prevent inflation from beginning to move higher again.
So put all this together for us. I mean, we've talked a lot about what this all means for the economy. What could it mean for the markets this year?
I think if I just think about this very simply, so interest rates higher means that if we are a firm, we will have higher debt servicing cost. Higher debt servicing cost means that the stock price should go down. So on its own, when interest rates go up and debt servicing costs go up, that should be negative for equities. But the important thing here is that interest rates are going up because earnings are good. So if you at the same time have that GDP is good, earnings is good, the consumer is good in aggregate, well, maybe that tells me that, well, if everything is good on the earnings side, well, stocks should then be going up. So I would say that ultimately, if we still have a few more quarters, which would be my expectation, where growth is going to be strong, earnings is going to be good, the consumer seems to be fine, well, then maybe the market, credit, IG, high yield loans, capital markets will still get a lift from the economy actually still doing well. And unfortunately for the Fed, that also means that inflation is a risk of also getting a lift. So therefore, the effect of interest rates being higher for longer, meaning I have higher debt servicing cost, is being overwhelmed by the fact that earnings are still strong. So that would argue ultimately for the market, S&P 500, probably still doing okay. Yield levels being very higher, and of course in our world that means private credit yields continue to look very attractive because the Fed now has to keep yields higher for potentially a good deal longer than what they thought just a few months ago.
Torsten, we always love having you on set.
So great to have you
Great.
here.
Thank you for helping us kick off the show.
Anytime.
Appreciate it.
Anytime.
Moving on, Apple set to report earnings after the bell today. Yahoo Finance's very own Dan Howley is here with how to and what to expect from the iPhone maker's second quarter, Dan.
Yeah, Josh, we're looking at a pretty interesting potential report here. This is probably one of the most consequential for Apple in some time. There's reports that iPhone sales have fallen 19% in the quarter. That's from Counterpoint Research, while the rival in China, or China's homemade rival Huawei, which, by the way, doesn't just sell in China, but around the world, is supposed to have taken a good deal of market share back. And just to put that into some perspective, when the U.S. more or less kneecapped Huawei in 2019, they started to see their market share decline. Apple, in turn, rose because, well, there weren't high-end Huawei phones available, and so Apple became the high-end phone of choice. Now we're kind of seeing that flip back, where Huawei's coming back, Apple is losing some of that market share. There's also the issue of Mac sales. Mac sales are expected to be lower. iPad sales are expected to be lower. Wearable sales are expected to be lower. The big bright spot is supposed to be services, and that's expected to be up 11% year over year. I think that's going to be something that Apple's going to hang its hat on, probably lead with that.
What do you think, Dan, is driving that under the hood? App Store?
It's App Store, it's subscriptions to Apple One. They merged all of those kinds of services that you can get there. There's obviously Apple TV Plus. They're getting a lot into more into live sports. Apple Music doing well. And then, I use Apple Fitness Plus. It's because the spinning is the worst thing on the face of the earth in there. And I do it, and my wife hears me curse every time I'm on it. But I think that's going to be the real standout. And it's worth pointing out, by the way, that Apple does have an iPad event next week, or a rumored iPad event. They essentially telegraphed it in their announcement.
Right.
But so we should learn more about iPad there. But the revenue there is expected to fall 11% in the current quarter, or in the prior quarter.
I mean, there has been some talk, though, that maybe they will benefit from low expectations, right? The stock is down about 10% this year, and there has been already a lot talked about in terms of that weakening demand from China. So maybe,
I think that was when Tony Sock and I upgraded to buy.
Yeah.
I think that was part of the thesis, is that, in his opinion, it's gotten knocked around and valuations now looking more attractive.
Right, and at the same time, there's been some leaking reports that maybe some new AI capabilities are finally going to come at long last, but who knows?
It's interesting because the AI aspect, I mean, I was saying this yesterday, there's right now the consumer case just isn't really there yet, right? It's where I think of, I'm a tech nerd, so I'll buy whatever, right? Why would my parents buy this? Why would my brother buy this? Why would somebody who's not necessarily a tech nerd, who's more interested in does the camera work well? Does the screen work well? Is the battery good? Is this going to be the fourth thing that people start looking for when they go to buy a phone? Because the other three, they're pretty well taken care of at this point. Is this going to be the fourth thing that people start looking for? We'll have to wait and see. But right now, I haven't seen anybody who's brought out a use case for the regular consumer that's truly worthwhile.
There hasn't been a feature or tool yet you've seen that, like, okay, this could really jumpstart a meaningful
the
upgrade
killer
cycle.
app, as they call it.
There's nothing there.
Yeah. I mean, and it's interesting because when I talked to Akash Palkhiwala, the CFO and COO of Qualcomm this morning, he said a year from now, 100% of their chips are likely to have some level of AI capability. So, like, everybody's preparing for it.
Well, I remember Intel announced their chips back in December, their Ultra line of chips, right? The Core Ultra, and they said that they have neural processing engines in them, or neural processing chips in them, which is for AI. And then I said, well, why do my mom and dad need this? And they said, what? Like, there was no answer to that. And then they said, developers need to come up with it. It'll come,
right,
presumably.
But not yet. All right, Dan, thank you so much. We're excited for those Apple numbers, and of course, we'll be bringing them to you. We're just getting started here on Market Domination. Coming up, another busy day for earnings after the bell. Did we mention? We got the latest from Apple, but not just that. Block, Coinbase, and more. Plus, Paramount shares are jumping on a report of a $26 billion takeover offer from Sony and Apollo. We're checking on the media giant as well as a few other trending tickers on the other side. Plus, it's the latest edition of our series, Goodbye or Goodbye. We'll take a deep dive into two stocks to help you make the best choices for your portfolio. Stay tuned, more Market Domination after this. Let's take a look at some of the top trending tickers and top movers as well. Paramount shares among them. They're up 13%, those shares, on reports that Sony and Apollo Global have now submitted a $26 billion takeover bid. Yahoo Finance's Alexander Canals here with more. Now, this was one of the bids that was talked about.
Right.
But now the report is it actually has been made.
Right. So now we have this formal offer, hence why the shares are jumping today. Now, this bid would essentially make Sony the majority and controlling shareholder of Paramount, with Apollo serving as the minority stakeholder here. And to know, Apollo Global is a parent company of Yahoo Finance. But like you said, Julie, this is something that had been talked about. Of course, in the background, we have this Skydance deal. We know that the exclusive negotiation window for that deal officially expires tomorrow, Friday. It is very possible that we could see those deal talks be extended as a to work through the nitty-gritty and details of the proposed bid, because we know that shareholders, they've expressed some concerns over this Skydance deal. They'd much prefer a simple deal like Apollo is offering, $26 billion, all cash. That's a premium for those shareholders. And with the current Skydance deal, there's not a lot to love if you're that non-voting group of shareholders. So this will be interesting to see what comes out over the next few hours, over the next day, with that exclusive negotiation window officially expiring, I should say, tomorrow. But right now, shareholders certainly loving the possibility that Apollo Global and Sony could be involved here. Shares again up around 13%.
All right, thanks, Allie. Appreciate it. Shares of Carvana, meanwhile, they are riding higher after first quarter results surpassed Wall Street's expectations. The company reporting net income of $49 million compared to the $286 million loss from a year ago in the same period. Yahoo Finance's Praz Subramanian joining us here to discuss. Praz.
What happened with Carvana? I'm
This is my question. This is the question.
I think everybody's shocked.
Eye-popping numbers of real profit, a net income profit here. Revenue up 17%. Record adjusted EBITDA. Also, the most important thing there they talk is about their gross profit per unit, car per unit, $6,400 up from $5,300 a year ago. So significant improvement in profit per vehicle. I have to ask what's going on. That the Garcias, the father and son team there, somehow turning around this company that many thought would go bankrupt. I don't know how they did it. Are they not reconditioning vehicles? How are they not hemorrhaging cash? But they seem to have done this. They're going to actually be able to pay off their upcoming debt coming up in 2026, I think, in 2028. So they're saying that all the right things, and they expect more profit to come in the future. So it's really sort of a remarkable story here. Not sure how it's done, how they're doing it, but it's happening.
Well, there's the fundamentals, and then there's the stock reaction, right? Because we are seeing a huge push upward, although it's not that unusual for Carvana to see big swings in the stock. But I checked, 27% of the float is shorted, according to Bloomberg data. So effectively, part of what we're seeing today is a short squeeze.
Yeah, I mean, last night when they saw the results come out, and the stock went crazy. That's my initial thought, right? Low, thin volume, heavily shorted stock. This is kind of what's happening now. I mean, you look at a long-term chart of the stock. It is down still a lot from where it was before. It's just that now is trending towards one, and now it's up to $118 a share. So a big turnaround story. Got to keep an eye on this, but I'm still curious. How are they able to do this? It's shocking to me.
Good question. Yeah. All right, thanks, Pras. All right, let's take a look now at shares of Fastly. The stock sinking after lowering its full-year revenue and profit outlook. The company also hit with downgrades from D.A. Davidson and Bank of America Securities. And over at Bank of America, Madeline Brooks saying that the company is seeing decelerating growth in its largest customers and limited visibility in the second half of the year.
Yeah, it's also interesting always to kind of check out on a day like this what a bull's saying, Julie. And team at Piper, they were telling their clients, listen, our prior view around customer concentration risk has come back to bite. They were noting some large customers, they say, put pressure on pricing without any further traffic commitments at quarter end. It looks like they actually stay at an overweight. They did take their target, though, down to 11.
Yeah, so even the bulls not feeling so fantastic.
Yeah. Shares of data management software company Informatica lower in today's trade, despite reporting a solid beat on the top and bottom lines for the quarter. Informatica's CEO Amit Walia joins us now. Amit, it is good to see you. So you report results, Q1 adjusted EPS beats, Amit, beats on the top line as well. Maybe just start there. Walk us through the quarter. What drove it?
Great to be here. Thanks for hosting me. Well, a great start to the year. We obviously ended last year on a very solid note. Started this year with a clean beat, as you said, from top line to bottom line. The highlight being our cloud ARR growing 35% ahead of the guide that we did, and also the non-GAAP growing almost 29% and a huge beat in the unlevered free cash flow. We feel pretty good about where the business is as we start the year.
I have to ask you, Amit, we are seeing kind of a muted response to the results, even though, as you said, the numbers did beat estimates here. What do you make of that, and what conversations are you having with investors?
Well, look, I mean, as always, we look at the long term. I mean, we've had a significant value creation that we've had in the last year, and this is the start of the year. We've guided very strongly to Q2. From where I sit, well, look, the adoption of our platform is going great. We have 92 trillion transactions a month, growing 60% year over year. We are the only platform in our industry. We're gearing up for our user conference that's basically already blowing all numbers. So I'm excited about all the trajectory of digital transformation as well as Gen AI headed towards all things we do. We have a long year to go, and I think I'm excited about holding the guide for the year and getting ahead of it.
I'm curious, Amit, the kind of this M&A reports that were circulating around the company. Any evidence, Amit, that had any kind of impact on the business? You know, customers perhaps delaying decisions because they weren't maybe sure what the business was, where it was going to be in the near to intermediate term.
Well, I heard the rumors too. Well, I mean, look, the reality is that customers engage with us for long-term, mission-critical transformational initiatives. And in that context, look, Q1 was actually a solid beat across top to bottom end. We didn't see any of that stuff. And it's the smallest quarter for the year. Every year we ladder up towards building the year, heading towards the second half, which ends up being a very strong execution year for us. And that's how this year is shaping up as well.
Amit, one of the things that you talked about a bit on the call is sort of the concrete examples of customers using AI and how that's flowing through to your business. And that seems to be, well, that's what we've been looking for when we're talking to people like you. That seems to be partially what the street's looking for too. Can you share with us some of those examples for our viewers?
Absolutely. I mean, I was listening to a segment before. I think there's a lot of talk on Gen AI, but I think what I'm excited about is what customers are actually trying to do. And look, we have two use cases. One is our products being used for Gen AI, and then Gen AI from us, our GPT version. And what we're seeing is customers using our IDMC platform to actually, as an example I gave, as a loan approval mortgage company, bringing data from all places, putting quality on top of it, governance, to actually make smarter, faster decisions, much more intelligent decisions of loan approvals, reducing their risk, and also telling customers exactly where they lost out if they did. And those are the use cases that are coming out that are really helping customers drive their top line and also improve productivity. That gets me excited about this year and the many years to come for Gen AI being a tailwind for us.
And I'm also just interested in taking a step back, just on your take on the general demand environment. You've got customers all over the world, Amit. When you talk to them, what are you hearing? You know, are they in cost-cutting mode or no? They're investing, and if so, what areas?
Yeah, I'm talking to CIOs and CDOs across the globe. And I think if you step back, the demand environment is relatively stable. IT budgets are not growing a lot. But what's happening is it's getting reallocated towards what I call more value creation initiatives. And, data, Gen AI, those initiatives, cybersecurity initiatives are generally getting beneficiaries. So we are seeing that help us. Obviously, it's reallocation that's happening in that case because overall budgets are not generally increasing exponentially. But I think customers are getting out of defense mode and getting, even in that reallocation, getting towards offense, value creation initiatives, transformational initiatives, and we are seeing that open up much more now.
And Amit, what about you guys in terms of your spending plans?
Well, look, pretty stable. I mean, I think we've obviously been leveraging Gen AI ourselves for being much more productive. But I think we've been very stable in generally invest in all the right transformational initiatives, creating top-line growth for us mostly. And of course, basically leveraging all things to drive productivity in the back office. But it's all been more driving front-end revenue-generating initiatives for us.
Amit, thanks so much for joining us. We really appreciate it.
Well, thank you very much for hosting.
Take care. A busy day in the healthcare space. Meanwhile, shares of Novo Nordisk are under pressure despite strong first quarter results led by the blockbuster GLPs, Ozempic and Wegovy. In the meantime, in a different part of the healthcare space, Moderna shares are popping after a narrower than expected loss and upbeat sales in the first quarter. To put it all together, here is Yahoo Finance's Anjali Kamlani, who spoke to executives at the company.
I did. Forgive me laughing, but it is quite funny because the company that did really well, their shares are down, But the company that didn't do so well, their shares are up. Go figure. So yes, we'll start off with Novo Nordisk. The company beating on most fronts, did miss on the Wegovy sales, and that's what kind of put the company under pressure. We are seeing that the Wegovy numbers are dropping, prices are dropping, but manufacturing supply is increasing. So put those two into context, the company does have a pretty strong growth story, and as expected, the GLP-1s really driving that growth for the company. I spoke to CEO Lars Jorgensen about that and about what it means to have those changes in price, especially as we know the U.S. government is in particular interested in Ozempic and Wegovy pricing. And here's what he had to say.
Really what companies compete on is the price after rebates, fees, discounts, whatever. And there we are actually giving the product at a price point that's 40% lower than when we launched. There's a lot of complexities, I acknowledge that. So I think it's important to get into the details of these to get a true and fact-based discussion around price development in the US market.
Meanwhile, Moderna, the company that has been known for the COVID vaccine and the decline in demand there, did see narrower than expected losses because we've seen an increase in booster uptake, as well as other markets in the world. The company saying that now Brazil, for the first time, is a new market for it. So despite the fact that most people thought that story was dead, it seems to be alive and kicking. So I spoke to CEO of Moderna, Stefan Bancel, about that, and here's what he shared with us.
What was interesting in Q1 is that in the US, people kept getting vaccinated. So of course, not like in Q4, but you see a lot of people getting vaccinated, some people getting a booster, especially people at high risk. So that was a pleasant surprise. And then some countries, like, in the Southern Hemisphere, getting ready because, of course, the opposite season. So in Q1, it's their fall. And so they start getting ready in terms of purchasing vaccine and so on.
So it looks like there is still a market out there, smaller than most anticipated, but still something to look at.
Well, and then there's looking ahead for Moderna, right, at some of the other products that they're trying to bring online. Did we learn anything new today on that front?
Not so much new, but just an update. Obviously, their partnership with Merck on Keytruda, that's a big one that they have to look at. RSV is coming online. We already know that they've applied for that to get into the market. So that should be on for this fall, for that season. So it could mean that there are more products for them to gain revenue from, but if you look at quarter over or year over year, down 91%, obviously that tells the story. And so just like competitor Pfizer has had some pressure from investors on what their near-term growth outlook looks like, Moderna has some of the same questions facing it.
Makes sense.
All right, Anj, thank you. Appreciate it. Coming up, it's the latest edition of our series, Goodbye or Goodbye. We'll take a deep dive into two stocks to help you make the best choices for your portfolio. Stay tuned, more market domination after this.
It's a big, noisy universe of stocks out there. Welcome to Goodbye or Goodbye. Our goal to help cut through that noise to navigate the best moves for your portfolio. Today, we're taking a look at key differences in two companies who are leveraging AI, or trying to. Here to discuss, we've got Headline Venture partner Cameron Ansari. Cameron, come on down here. Let's get straight to your buy stock. Thanks for being here. It's good to see you. Your buy stock is Pinterest, which of course we just heard from in terms of its earnings here. And some of the points that you look at when it comes to the stock are kind of reflective of what we just heard. The stock's done pretty well over the past year. So first of all, you talk about user growth accelerating and some of it sort of re-accelerating as well.
Right, and obviously I used to work at Pinterest. I'm a big believer in the company and still hold a number of the shares. They've re-accelerated growth. This quarter, you saw they're up to 518 million global users. And keep in mind, about 80% plus of the user base is now outside the US. And those users have, at this point, been monetized very little. So there's a lot of headroom left to get after those 400 million plus users that are non-US and start to monetize them. So most of the revenue you're seeing today, as impressive as it is, almost all US.
Okay, so let's talk about the monetization story a little bit more here. What is that trajectory going to look like, and what is the kind of growth that we can expect?
Right. Well, the holy grail for Pinterest has always been shopping and making people be able to actually buy stuff instead of discovering and saving and creating the boards. And Bill Reddy joined about a year and a half ago or so from Google and PayPal before that. He's very savvy about shopping and e-commerce, and he's tried to build more tools in the system to actually help you get and close the loop from just seeing that pin, discovering and saving it, to actually buying that thing, taking that trip, purchasing the sofa, getting the barbecue, whatever it may be. And again, that's early days right now. And they have the partnerships with Amazon and Google that are launching that I think are going to help them in that department as well.
And just a quick side note, why do you think Pinterest has been successful in competing against the like of other social shoppable sites like a TikTok, or we've got Instagram also that has some of that capability?
I think part of it's different swim lanes. So I think on Instagram, you have sort of that impulse buy. If I don't buy it now, I'll never see it again in the feed type. You're not saving an Instagram ad to a board. Whereas Pinterest is more the contemplative, considered purchase. It's the sofa. You're not going to buy a sofa from an Instagram feed.
Right. Yes, that makes sense. And then also, in terms of another point that you're looking at, you said the business is aging down, which is not a term I've heard before. So explain what you mean.
So Bill used it in the, I think in one of the analyst discussions after the earnings call, but most social media and consumer internet companies, the newer ones like a TikTok or Facebook and Instagram, they start with a younger generation, and the audience gets older and older and older as more sort of less tech savvy, older audiences gravitate towards it. Pinterest started with kind of an older audience. They were sort of more middle-aged women, middle America was the initial audience set in the US, and the audience has now expanded to millennials and now to Gen Z. So the fastest growing segment for them in the US are younger users, those who are kind of 18 years to 25, 26, which is a great thing to see because you're going to capture that user at the start of their sort of consumer life, if you will, and hopefully have them for many, many years to come.
Interesting. All right, now we always talk about the risk to the upside here, and in this case, it's that there's a lot of competition out there.
Yeah, especially for ad dollars, right? And Pinterest has one line of revenue. That's it. They sell ads on Pinterest.com and the Pinterest app. There's no software, no data, no other stuff. They don't have a B2B business or like Google with Sheets and Cloud and all that. So for ad dollars, most buyers, if they're going to have $1 to spend, they have to decide, am I going to go with Google or Facebook, or am I going to maybe do a test budget with a Pinterest or a TikTok, maybe Instagram, although these days Instagram is pretty sizable. So that's always been the thing with the Pinterest or Snapchat, which are a little smaller. Can they capture that always-on ad budget and continue to have that from these big buyers?
So far, so good, but we'll see what happens going forward.
Yeah.
All right, let's get to the stock that you do not like, that perhaps is not using AI in your view as well, and that is Upstart Holdings. That stock already reflective of perhaps this pessimism here. But you say the AI, everybody's got an AI story now.
Right, and look, and these guys came out in 2021 and went public at a price of, I think it was $390 a share. I think at one point it was like a $70-80 billion market cap company.
And this is a fintech company.
It's a fintech company. They do a lot of lending, and probably a great team. I've met with them in the past. A lot of respect for what they do. I just think the stock is still a little overvalued because the story they were selling in 2021 was that we're leveraging AI to do lending. We're leveraging AI to get customers. AI is the core of our business. And back then it was a very novel story. Today, the bodega, my 9-year-old, everyone's got AI. So having AI as part of your narrative is no longer as unique. I also think it's a dangerous thing that people haven't thought about and they're thinking about more and more now. Consumer lending using AI has some regulatory issues, where you have to be very careful about making sure the models are not shifting in a way that's being prejudicial or not lending in an equal way to folks. So I think it's something to be very careful about, and I think it's no longer as unique a story as it was.
Well, and speaking on that front as well, and we were just talking about competition with Pinterest, here there's a big competitor in this industry, and that is SoFi.
Right. And the reason I like SoFi a little bit better is that SoFi actually diversified their business by buying Galileo. And Galileo is a big infrastructure play that does card issuing and provides software for other financial companies. So I think Galileo diversifies away from just being a lending business, which is what SoFi used to be initially.
And then whether you're SoFi or Upstart, you're subject to higher rates, which is what's happening right now, or the rates are at least remaining higher.
I was just at a conference yesterday about the rate environment, and we don't think that, most economists don't think that the rates are going to come down quickly anytime soon, right? So the rates are going to be probably at this level for the foreseeable future. And the one thing that really troubled me about the Upstart report, the most recent one, was even their prime borrowers, their best borrowers, are showing higher delinquency rates. So once that starts to happen, I think you can obviously see that trickle down to the less prime or subprime and the lower quality FICO scores. So I think they're going to have a tougher time with the delinquencies and the returns on their loans.
Well, just like we talk about risks to the upside for Pinterest, we talk about risks to your downside case for this one. And in this case, it's that the stock's already down a lot.
It's
so
already
maybe
down
it's
a lot.
Priced in
Yeah,
some of this.
exactly. I know it's on a number of the short lists and so forth. So it's already down quite a bit. Maybe it's at a level now that's appropriate. That it's trading at about, I think, 4 times price to sales. SoFi trades at like 3.5, though.
And you said you still think it's overvalued.
I think, because again, if SoFi, which I think is a more diversified, potentially a better company, is at 3.5, these guys are still a little expensive.
Okay, thanks a lot, Cameron. Well, let's sum up what you're telling investors here. You're saying you would buy Pinterest amid that accelerating user growth, potential boost from e-commerce and monetization, and the business appealing to younger generations. On the other side, you say avoid Upstart. Its AI story is losing its shine. It's facing tough competition from the likes of SoFi and the pressure the company is feeling from that higher rate environment. Thanks so much for being here. It's good to see you in person. And thank you for watching Goodbye or Goodbye. We'll be bringing you new episodes 3 times a week at 3:30 p.m. Eastern. Stay tuned, more market domination on the other side. Checking in now on a few pandemic darlings that are facing some headwinds. Let's start with Peloton. The shares in the red today. CEO Barry McCarthy stepping down from his position at the fitness equipment manufacturer after 2 years on the job. And after missing third quarter earnings estimates, Peloton announced a restructuring plan that will lay off 400 employees from its global workforce. Now, Peloton already has done a number of restructurings, already has cut workers, but things are still not kind of coming together.
Yeah, McCarthy, as you know, Joe, I mean, he is pretty new. He only started in early 2022, and you know, he had this strategy of the company, which we talked on the show about. It was, you know, emphasizing the services and the partnerships rather than just those pricey bikes, but it has been a struggle. So now board, obviously they're going to look for a replacement. Big restructuring announced again. So cutting the workforce sounds like by 15%, reduce annual expenses by more than $200 million. Looks like they also narrowed their guidance for revenue in this fiscal year.
They did, and they've also been, you know, they've pivoted to less reliant on the hardware, more trying to build subscribers, but they also cut their subscriber forecast for the full year. So thought there was some interesting commentary from friend of the show, Simeon Siegel of BMO, who's got the equivalent of a hold rating. He says, we continue to believe growth is behind us. He says that the company should walk away from expensive growth hopes and continue to focus on sustaining free cash flow for the company.
Even before today, by the way, this stock was already down about 50%.
It's at a record low
this
today.
year. Yeah, incredible. All right, moving on. Shares of Etsy, that's another one, sliding today on the back of their earnings report, saw weaker than expected guidance. So this one, Julie, the story here was really just weak discretionary spending, and that's what the CEO talked about. I mean, he put it pretty plainly when earnings crossed here in a statement talking about a challenging environment for consumer discretionary products, which is, you acknowledge, a headwind. Company missed on a number of metrics relative, at least to the street's expectations, and the stock just getting hammered here.
Yeah, definitely. Gross merchandise sales is the other key metric that people watch for Etsy, and that too, that's basically the value of all sales on the platform, and those fell 3.7% to $2.99 billion. The commentary from Yigal Arunian over at Citi, who's got a neutral rating, said that at this pace, Etsy's now on track for 3 straight years of gross merchandise sales declines. He says macro is a factor, but there's really little visibility here as when things are going to improve for Etsy.
Investors seem to agree, for sure. Moving on, wide leg pants. They are in. That's the trend our next guest is seeing, and it's bad news for athleisure share company Lululemon. It's according to her latest note on the company. Here to explain why is Barclays consumer discretionary analyst Adrian Yee. Adrian, it is good to see you. So you take Lululemon down, it looks like, to basically move to the sidelines here. It's now equivalent of a hold, Adrian. How come? Walk us through the argument.
So the argument is that there is the first denim trend that we've really seen in the past kind of 17 years. So Julie, you were around kind of the whole notion of the big over the little, the skinny leg silhouette. They got skinnier and skinnier, the jegging. And then finally, we've been in the past, 5 years in this kind of topping moment for athleisure. And so here comes along sort of after 5 years, we've been showing this kind of wider leg, baggier leg. And we're in this kind of, early adoption to mass adoption. And that's the part of the cycle where it starts to speed up. And the wallet, these 15 to 25-year-old female needs to make space in the wallet. And she's going to buy, she's going to forego things she has pre-existing to make room for the stuff that's not existing.
Adrian, I'm here on the Lululemon website. It's great to see you, by the way. Indeed, I've seen a lot of trends come and go. I'm here on the Lululemon website. And, they got the leggings, but they do have some things that are a little wider leg, right, that are trying to sort of capitalize on that. Are they going to capture any of that wallet share that's going to the wider leg styles, do you think?
So the wider leg styles are flares. You're seeing the yoga pant go there. You're seeing sweatpants. It's just kind of bigger, baggier, more comfortable than that kind of clinical black legging. But the actual trend is grounded in denim. And so there's the look and the silhouette shift, right? The bigger on bottom, the croppier, littler on top. But there's also a reversion back to this kind of teenager wearing clothes, right? Like denim, right? And kind of not hanging out in that athleisure look. So I think it's 2 parts. Yes, they can kind of like do a style that's more in the baggier and wider leg, but they aren't going to be going to denim. And that's the call.
And Adrian, if that's the move, so these wider leg bottoms, who's going to capitalize on that, Adrian?
Oh, American Eagle. So American Eagle is in what we call the bullseye. They're in the teen space. Way back when we did this, 15 years ago, there used to be what we called the 3 A's in the teen space: Aeropostale, American Eagle, Abercrombie. Abercrombie has moved older, right, to this kind of mid-20, cohort. Aeropostale is no longer. Express just filed Chapter 11. And so you're kind of looking at American Eagle and saying, look, they're the number 2 denim player behind Levi. Surprisingly, they do 40% of their business at AE brand in denim. They can sell you the 2 tops. They can get you into the bottoms. And so they're sort of like uniquely positioned to capitalize on this, particularly in the back half of the year when we go to back to school, back to college.
It's interesting, though, at the same time, when you're looking at Lululemon and you just have an equal weight rating on it, and you say it's still going to maintain some level of market share, right? It's just not going to see maybe the same growth that it had seen in the past?
That's absolutely correct. So what we did is we took, we kind of have a price target that's a little bit higher than where the stock is trading. We didn't take down our numbers, right? Because the company had already guided for kind of 10 to 11% top line growth. If there is going to be any risk of this, it's going to be more in the back half of the year, which we don't really know what the uptake of this trend is. And at the same time, the company had talked about zeros and the lack of color. And those are things that they can fix, over the next course of the next 3 to 6 months. So really the call here is there could be some unknown risk depending if this kind of really does accelerate in the back half of the year. But as we sit here right now, we don't see much margin or EPS upside. And so, stocks that you want to be overweight, you want to be basically having a multiple against numbers that are actually beating consistently over the next 4 quarters. We don't see that happening here with Lulu. But we do see it happen with Eagle.
Adrian, another subsector you follow is that casual footwear subsector. Adrian, any kind of similar style shifts you're seeing there and ways for investors to play it?
Of course. When you go head to toe, right, you got to get to the bottom. And when the bottom, the leg opening, so these are all these like little tidbits in retail. When the leg opening changes, the footwear changes. So we've been paring back to, in this athleisure style, a peaking moment in athletic performance, particularly in run, right? Everybody's wearing run to go everywhere, right? And it really was the perfect sort of pairing to this kind of athleisure look, right? Even if you were wearing it to and from the office. And so with the wider leg opening, we actually think you're going back to a more casual flat bottom. Who's really killing it is Adidas with the Samba, the Gazelle, the Campus. That is the quintessential look right now. And so you remember in 2017, we had this kind of topping moment of the Stan Smith, the 3-stripe, the Air Force One. That's where we're heading back, right? So UGG benefits there, a little bit more of this Crocs, and kind of the, at the margin, right? Not as much of the running shoe look.
Yeah, I'm seeing a lot of flat Mary Janes and ballet slippers around here too, Adrian. Listen, if we're going H to T, we got to include the face, I guess. I want to just detour for just a moment into Ulta, which really disappointed with that pre-announcement that we heard, and I think caught a lot of people off guard. And I know that you commented on that as well. What do you think happened there, and what's the major trend to keep an eye on when it comes to beauty?
So in the beauty segment, we are also seeing, 2 categories that during the COVID, kind of post-COVID, really had their sort of topping moment and are kind of normalizing. So if you think about the beauty, the makeup trend, it really, really had its like high point, like moment when masks came off, right? In the early 2020, spring of 2022, mask mandates came on, and we had this saying like masks gone, makeup on, right? Everybody had to like replenish their makeup in 2022. We saw some of that, particularly with the social media in the mass channel, right? The TikTok trends that were phenomenal in 2023. And now we're anniversarying that. And like I said, if this teen needs to make a little bit more room in the wallet, she opens her closet, she has athleisure. She opens her cabinet, she has quite a bit of makeup. And so we're seeing Sephora do exceptionally well. I think part of this is that Sephora in Kohl's, Ulta in Target, are right in their kind of wheelhouse in their real estate, and they're showing up next door, in some cases in the same mall strip.
Interesting. Adrian, thank you so much for joining the show today. That was great. Appreciate it. While wrapping up today's market domination, don't go anywhere. We've got you covered with all the action following the closing bell, including another full round of earnings headlined by Apple. Stay tuned for market domination overtime.
There is the closing bell on Wall Street, and now it's market domination overtime. So let's get you up to speed on the action from today's session, sponsored by Tasty Trade. We had rally here for the second day as people were sort of still digesting what we heard from Jay Powell yesterday and looking ahead to Apple earnings. We saw all three majors rally here. The Dow gaining about 323 points, 0.9%. The S&P up about the same on a percentage basis here, and the Nasdaq up about 1.5%. Pretty broad-based advance that we had here for the major averages as well. And as stocks rallied into the close, the S&P 500 closing higher for the first time in 3 days. Yahoo Finance's Josh Schaefer is here with a look at some of the takeaways from the trading session.
Yeah, Julie, I mean, to me, it just seemed like the market generally liked that Federal Reserve Chair Jerome Powell said that rate hikes are not the most likely next move, right? That seemed to be, seemed to be what took us higher yesterday, right? And then I know we talked about at the end of the day yesterday, it didn't really keep stocks higher, and we saw stocks sort of tail off at the end of the day, but that trade kind of picked back up today, at least from my perspective, from what I saw. When you take a look at something like the Russell 2000, which has been a good indicator to me sort of what the markets are feeling about the Fed on any given day, right? On days that we see cuts get taken off the board, the Russell goes down. On days that we see people feel more bullish about the outlook for the Fed, the Russell goes up. And the Russell finished above the S&P 500 today, closing, I think, up about 1.5%.
And by the way, you were asking me in the break what we heard from Torsten Sock of Apollo earlier, and he spoke specifically about small caps and about the Russell. And he pointed out that the reason, at least one of the reasons, that we see the Russell be so sensitive to that outlook for interest rates is because those smaller cap companies tend to carry higher debt. Mm-hmm. And so they have high debt servicing costs if rates are remaining high. So that just a little aside here.
And to that point, though, it is interesting, I think, sometimes when you do see the Russell rally like this, because one thing Powell didn't say yesterday necessarily was when we're going to get cuts or how many cuts we're getting. So at some point,
we don't know when it's getting better for that on that front, but we know maybe it's not getting worse.
Right. So I guess maybe sometimes that's good enough, right?
I guess so.
And I think also with that too, one thing that we saw today when you take a look at treasuries, that the 10-year yield hit its lowest level in 3 weeks. We've been talking a lot about the rise in the 10-year and how that's been a headwind for stocks at some point, and also headwind for something like small caps. Mm-hmm. And to see that come down 12 basis points in the last 2 trading sessions, I think does matter in areas like small caps.
And what also matters are earnings. Imagine that.
Yeah.
And that's something Torsten also talked about, by the way. He said, the fact that we continue to see growth from earnings ultimately will be the thing that powers stocks higher.
And it'll be interesting to see when we start to see a little bit more of a focus on that from the market, right? When do we get away from maybe the macro focus and being worried about the Fed to perhaps these earnings, which I think in large part people seem to feel pretty good about for this quarter. You're looking at earnings growth right now pacing at about 5.5% for the quarter for the S&P 500. That was from Evercore out today. That's combining expectations for the rest of the quarter with what we've seen thus far, but it's higher than the 3.2% that was expected, which of course normally happens. But generally speaking, it's been pretty solid, and it's been interesting to see some companies that haven't done as we've talked a lot about companies that have done well going into the print and then don't see a big move because they're sort of not raising the bar enough. And to me, it was interesting. Yes, it's a highly shorted stock, but a stock like Carvana today coming out and surprising and catching a bit off that. I do think there was some short interest that drives your stock up 30%, but it's interesting to see the street thinking the company's gonna come out with a negative profit for the quarter, and it actually comes out positive, and you get a more positive reaction to that. Perhaps maybe a little bit of a parameter there, because for some of the companies that have rallied into the print, the expectations are just a little too high.
Maybe so. All right. Thanks so much, Josh. Appreciate it. Well, Federal Reserve Chair Jerome Powell keeping the idea of a rate hike off the table, but he did acknowledge the Fed still has a long way to go to get inflation down to its 2% goal. Joining me now is Eric Rosengren, former Boston Federal Reserve president and MIT Golub Center visiting scholar. Eric, thank you so much for being here. We really appreciate it. So as we mentioned, Powell seeming to take the idea of a hike off the table. But do you think that he has somewhat painted himself into a corner on that front? In other words, do you think that actually a hike could be useful with inflation remaining this persistent, but because he has said it's not happening, it can't happen?
Well, I think what he said was it was unlikely to happen. And so it's not that it couldn't happen, but that his expectations for where the economy's going, it won't be necessary. And I think there are two elements to that. First is most forecasts still have the trend for inflation going down. So the core PCE, the PCE inflation is what the Fed focuses on. It's at 2.8%. I do expect that over the course of this year, it'll still come down another couple tenths. And while it may not hit 2 by the end of next year, it'll be pretty close to 2 by the end of next year. So in terms of just the general trend down, I think he has the same forecast I have, that that's a pretty likely outcome. But that being said, very small changes in components of the basket of goods that are measured for CPI or are in the GDP accounts for PCE can have a pretty big effect when you start getting to fairly low numbers. So the last 3 inflation reports have been disappointing, and he acknowledged that in the statement that the last 3 inflation reports have been disappointing. So I think in order for him to actually ease, he's going to have to see something like 2 favorable reports. I think that's still possible by the second half of the year, but the market started the year expecting 6 cuts. It now expects 1. My own expectation would be 1 to 2 cuts.
And at the same time, we talked earlier with Torsten Slok of Apollo, and he pointed out that because of the Fed's communication, that financial conditions have actually loosened to some extent. We've seen asset prices go up, for example. Do you think that the tone now is sort of appropriate so that we might, so that we won't see maybe further loosening before the Fed is ready to cut?
I think he's being very careful in what he's saying at the press conferences now. He is right that monetary policy is pretty restrictive at this point. So when you have an interest rate that's in the mid-5s and an inflation rate that's, using the core PCE at 2.8%, historically that's a pretty high real rate, which indicates that the Fed is being pretty restrictive on short-term interest rates, which is what it controls. But as you've pointed out, the stock market's been quite buoyant. And over the course of this year, I think that's a result of other factors, including an expectation that AI is going to change the productivity story. The fact that GDP growth has been surprising economists for the last several quarters. And we're looking, it wasn't so long ago that most of the economic forecasts were expecting below 2% growth for this year. They're now almost all expecting mid-2s for the course of this year. So that's a pretty big increase in expectations for what GDP will be like. And that obviously has implications for better corporate earnings that you were just talking about.
And on another front, relatedly here, one of our reporters is looking into this question of how the Fed is influenced or not by politics. And when you were part of the Federal Reserve back in 2016, according to the transcripts of the meeting, you said our own election is viewed by many as far riskier than the Brexit vote, and that uncertainty around the election might make us reluctant to move in September. What can you tell us about how you were thinking about the election at that point, and what you can extrapolate to how the Fed is thinking about the upcoming presidential election?
So uncertainty, if it's too large, does have an impact on the economy and has impact on asset prices as well. And so when you have an election where the two choices have quite different implications for policy, primarily fiscal policy, but things like tariffs and how we interact with our allies, that uncertainty, especially when it's a close election, is something that can be a source of significant uncertainty as we get into an election year. And just as in 2016, 2020, and probably 2024, I think it's quite likely that it's going to be a close election and that the two alternatives have pretty significant different views on what the role of government is and what the likely policies will be if they get elected.
Indeed. Eric Rosengren, thank you very much. Appreciate it.
Good talking with you.
Let's get to some more breaking earnings, this time from Coinbase. Jared Blickery is here with the details. Hi, Jared.
Hi there. We're looking at some pretty big beats on a lot of the key metrics, still going through the results, but let me give you the revenue, which was a big beat, 1.64 billion when the estimate was for 1.32 billion. Also, first quarter EPS came in at $4.40. The estimate was for $1.07. I'm not sure if that's an accurate comp. It might be GAAP versus adjusted, but I'll be looking at that. Transaction revenue, though, a lot higher than expected, 1.08 billion versus estimates of 775 million. That exceeded expectations by about a third. Also seeing trading volume 312 billion versus estimates of 285 billion. And this came in a quarter where we saw crypto in general just explode because of those Bitcoin ETFs, spot Bitcoin ETFs. We have seen Bitcoin and a lot of other crypto tokens come off of those highs. But if we go to the Wi-Fi Interactive here, I have our crypto stocks heat map, and you can see Coinbase itself is down 2 to 3% here. And let me just give you the 5-year history, well, actually 3-year, so we can go through its entire history back to the IPO. Top tick the Bitcoin market, Bitcoin was top ticked by Coinbase's IPO, and you can see it's had a nice run up here, which has coincided with that run up in Bitcoin crypto prices. So very much capitalizing on that, but still you can see the stock is down about 4.5% right now. So a little bit of a head scratcher as to what exactly could be causing that. A pretty long shareholder letter. So I will be going through that. We'll see if we can come up with any other explanations here, Julie.
Thank you so much, Jared. Appreciate it. We're going to be speaking to an analyst about it in a bit as well. Coming up, the CFO of Zillow joins me to talk the impact of more cautious home buyers. That's next on Market Domination Overtime. Let's recap the action from today's session, sponsored by Tasty Trade. All three major averages in the green here. The Nasdaq leading gains up 1.5%, while the Dow and the S&P gained about 0.9%. And also, if you look at the sector breakdown for the S&P 500, it's reflective of that strength in tech. The Infotech Index doing the best of the sectors in the S&P, but consumer discretionary also rallying, as did real estate, healthcare, and materials, the only two sectors in the red on the day. The continued sort of percolation of the Fed comments from yesterday, as well as some stronger than estimated earnings, helping power stocks higher. It's hard out there for home buyers. Just ask Zillow, the real estate company, issuing a cautious outlook for the current quarter, citing headwinds from elevated mortgage rates and weak demand from first-time home buyers. Still, the company posting a solid first quarter, beating estimates across the top and bottom line. With me now, Zillow's CFO, Jeremy Hoffman. Hi, Jeremy. Thanks for being here.
Yeah, thanks for having me.
So what can you tell me and what color can you give on what you are seeing from those first-time home buyers and where you are maybe seeing strength and weakness during the quarter, not just last quarter, but in the current quarter as well?
Yeah, absolutely. I think it's no surprise that when interest rates spiked the way that they did in the back half of the quarter in March and into April, we started to feel some impact in the housing market, and that was reflected in our guidance. I think at the same time, we look at what we did in Q1, and we outperformed the real estate market by 900 basis points. And that was on the back of strength from all parts of our business. So our residential business grew by 9%, excuse me. Our mortgage business, which is where we provide mortgages to through Zillow Home Loans, that grew 130%. And then our rentals business, which we shined a light on yesterday, grew 31% overall as well. And that was the seventh consecutive time in which we've outperformed the residential real estate market. So we feel really good about what we're in control of, despite the fact that home buying right now is tough.
You know, I want to ask you more about that rental business in a second, but first I do want to ask you about mortgage rates and when you expect some relief on that front and how that's going to flow through to your business.
Yeah, I mean, I heard it from the guests just before, how challenging it is out there to try to expect what the Fed's going to do. Our view is that housing's going to be roughly flat this year, and we don't necessarily take an in-house view on mortgage rates specifically, but we think the housing market's going to be flat as affordability continues to be a challenge. At the same time, we do know that it's a growth industry over time, and we feel like we're well positioned to take advantage of that, when the time comes.
So given all of that, it is interesting that you are making that increasing bet on rentals, right? That there is that rental portal on your site alongside the ability to look at homes for purchase. Is this a bet that this will be a prolonged cycle, that more people are not going to be purchasing homes, but rather are going to be looking to rent?
Yeah, I think it's more, what we're trying to do at Zillow is be a housing super app. So that means that we're providing services to anyone that's trying to move in any capacity, whether that's buying, selling, or renting. And rentals has been a bet of ours for a long period of time. We've invested against it as a result of that. And of course, having all the inventory on the home side and as much inventory as possible on the rental side is a benefit to our consumers because they know what's out there for them, whether it's the right choices to buy or to rent. And obviously in a moment like this, renting does make a lot of sense. And we like the consumer experience we're building, plus the business opportunity we see over time.
Jeremy, let's talk about the NAR settlement as well. National Association of Realtors, of course, this settlement that could affect how commissions are paid. I think everybody's still trying to get their arms around it. Talk to me about how it could affect your business. Could you see, for example, a drop in your income from the sort of premium listings, if you will?
Yeah, I mean, it's definitely noisy out there right now. Real estate is always a well talked about category, just given the importance it has in the economy and also just in people's lives. So it's definitely been a lot of speculation and big headlines. I think from our view, we think buyer agents, those that help people buy homes, add value. We've seen that over the nearly 20 years in which we've been operating Zillow. You put yourself in the shoes of a first-time home buyer, and you remember how confusing that process was, and how emotional it is, and how infrequent it is. We think real estate agents provide a ton of value, and will continue to do so regardless of the settlement. And then for Zillow, we orient ourselves around the most productive real estate agents, and the most productive real estate agents have been taking share over time, and we think we'll continue to take share. So we look at the opportunity and the evolution from here as opportunity really more than threat. And I think we've proven that out in the past, and we'll continue to look to do so.
Jeremy, thanks for spending some time with us. Appreciate it.
Yeah, thanks for having us.
Thanks. Let's talk about Coinbase. Those shares have been sliding after reporting first quarter earnings moments ago, down 2%. Earnings per share coming in at $4.40, revenue coming in at $1.64 billion. Both of those beating estimates here. So here to help us break down the reports, Steve Yang, founder and managing partner at Kindred Ventures. Steve, it's a bit confusing perhaps that we are seeing the shares go down because we did have what looks like a beat here. Transaction revenue also handily beating estimates here. First of all, before we get to what's going on with the stock, I am curious what you think was responsible for that transaction revenue performing better than estimated.
Yeah, I think, since last December with Bitcoin ETFs coming into play and getting approved and launching, it's just been a lot of tailwind for the company on their legacy business, their Chapter 1 business, if you will, which has been not only consumer trading, but now custody, and in particular custody for institutions. So the company right now is in sort of its second chapter of its life and journey after going public. It's now a provider to the largest financial institutions on the planet, not just for consumers that wanted to buy, trade, and hold crypto. And then, they've also launched a little over a year ago, a new platform for developers, which is the key to really getting long-term growth in as part of the picture. And so that's been a really exciting event. But I think the tailwinds right now are that transactions, also custody business, the institutional custody business are climbing well.
So let's get then to the reaction that we're seeing in the stock, which is a little bit negative here. I mean, the shares are up more than 30% this year going into this report. The company also said second quarter subscription and services revenue will be $525 million to $600 million. So that was the only forward-looking guidance that we got from them. I'm not sure how that compares to estimates, but do you see anything in here that you think is kind of gives you a little bit of pause?
No, I think, the markets are sort of, they swing emotionally based upon, excitement and momentum around any company that's doing really well or not. And I think in this case, there's probably a lot of exuberance over the last couple of days in the stock. And I won't speak to that as we're a venture capital fund that was an early investor in Coinbase. And our thesis remains the same as it was back in 2014, 10 years ago, which is that Coinbase was and continues to be the best company to build the pillars that create the gateway for crypto and traditional finance and the rest of the global markets to access and use crypto. And that was Chapter 1 that I referred to, which was onboarding customers, consumers, and then also now onboarding institutions, which is really important in the form of the Bitcoin ETFs and hopefully Ethereum ETFs that you'll see. But one of the biggest things that I think maybe public investors aren't understanding or seeing, and they will see over the next year or so, is that the new base layer 2 protocol that Coinbase built on top of Ethereum, which is one of the two crypto protocols that really matter today at scale. That allows them to now have developers essentially as users and customers. And that's really important for not only spreading into many other industries and the applications that these developers will build, but to use an analogy, it looks a lot like early Facebook with its developer platform, or it looks like AWS with its developer customers, where Coinbase can use their monetization products like their exchange, their wallet, their marketplace, their institutional custody, together with those integrated into those applications that developers will be building on top of Base. So this is a forward-looking strategy that I think is super interesting and will be a catalyst for Coinbase in the long term.
Steve Yang, thank you so much for giving us some reaction there to Coinbase. Thanks so much.
Thanks for having me.
Thank you. Want to turn to Block now, also getting some numbers there, and the company raising its full-year adjusted EBITDA outlook here to $2.76 billion, which is ahead of estimates. The shares surging more than 8%. This as first quarter adjusted earnings per share coming in at 85 cents, better than the 71 cents that had been estimated by analysts here, and net revenue at $5.96 billion in the first quarter, also above the $5.89 billion that were estimated here. The company also says it is announcing a strategic investment into Bitcoin, that it's going to invest 10% of its Bitcoin product profit into Bitcoin itself. It implemented a Bitcoin dollar cost average buy program here. So interesting to get that news in particular. The company's core business, it said Cash App revenue was at $4.17 billion in the first quarter, ahead of estimates. So that's happening on the one hand, but then on the other hand is this Bitcoin announcement as well. Now, I'm still going through the shareholder letter, full disclosure, but the first line of the shareholder letter is, why the hell are you all spending so much time on Bitcoin? And then they go on to try to answer that question. So I'll dig into that, and we'll talk more about that as we get more details. But in the meantime, those Block shares are going higher. That'll do it for today's Market Domination Overtime. Be sure to come back tomorrow at 3 p.m. Eastern for all of your coverage leading up to and after the closing bell. And stay tuned. Apple numbers, they're coming. Stick around. More Yahoo Finance after this. Welcome back to Yahoo Finance. We are about 30 seconds away from Apple's second quarter results, which are, of course, hotly anticipated, but perhaps with some trepidation here because the shares, remember, are down 10% or so year to date here. And the forecast is for revenue to have fallen again this quarter. It would be 5 of the past 6 quarters that had negative growth in revenue. There have been a lot of headlines coming out of China indicating perhaps slowing growth at the company. So we're getting those Apple numbers, Josh.
Yeah, let's get those Apple numbers right now, Julie, as they're crossing. Apple's Q2 EPS, better than expected, $1.53. The street was at $1.50. Revenue comes in at $90.8 billion. That is also better than expected. The street was closer to $90.3 billion. Gross margins clocking in at 46.6%. iPhone, $45.96 billion in the quarter. The street was closer to 45.76, so that's better than expected. Services also better, $23.87 billion. Consensus was closer to $23.28 billion. Mac, $7.45 billion in the quarter. Street was closer to $6.79 billion. iPad comes in a bit lighter than expected, $5.6 billion. The street was closer to $5.9. Wearables, home and accessories also a bit light versus expectations, 7.9 versus 8.29. A lot of focus we know on China, key end market for Apple, $16.37 billion in the quarter, and that is better than the estimates I saw. Those are calling for closer to $15.87 billion. Also remember, this is typically the quarter when Apple does update its capital return program, and we did get that news. The board does authorize an additional $110 billion for share repurchases. That was higher than at least some of the analysts I was talking to were closer to 90, and they also are raising their quarterly dividend for the 12th year in a row, Julie.
So the expectations, we could argue, were low going into it, but there was maybe some optimism percolating because the expectations were so low. So indeed, the company reporting the 5th time in the past 6 quarters that revenue fell, but it did not fall as much as estimated. The initial reaction in the shares does seem to be somewhat positive here because the numbers were a little bit better than had been feared, despite some of those areas that were perhaps a little bit weaker, including the wearables area. But, you know, iPhone is still massively, by far, the largest part of this company's revenue. And so the fact that both China and iPhone revenue were better than estimated, those seem to be the 2 areas of most concern. So that now seems to be reassuring, at least at first blush.
Yeah, and I did have the chance, let me bring this to you as well. I did have the chance to chat with Apple CFO Luca Maestri just about the quarter, the business trends and themes he's seeing. Some of what he pulled out for him that he would highlight. Luca, first of all, noted in terms of the quarter, that was an all-time record for services, he noted, up 14% year over year. He called that under the hood broad-based, said records, he said, in many categories and geographies. We did talk about the install base, obviously very important for Apple investors. That's referring to the number of active devices out there. He said that did hit a new all-time high. We talked about China specifically. Luca Maestri telling us, listen, the bottom line is we're not surprised. The economy over there, he says, is not strong, and the currency is weak. However, he said, listen, we grew iPhone in mainland China. We saw a March record, he told me, for upgraders over there, which was interesting. The 2 top smartphones in urban China, he told me, were in fact iPhone 15 and iPhone 15 Pro Max. He says he feels good about their position there. Another interesting question, Gen AI. We've talked a lot about that, right? And so one question I was getting, Julie, from the street was, is Luca going to kind of provide any CapEx update there? Is he going to lift CapEx spending, kind of looking ahead to kind of, maybe account for increased investment in Gen AI infrastructure? And Luca's saying, listen, he's going to give us the like this. We are making, he says, significant investments in Gen AI and innovation in general. Maybe we'll get some more color on the call. Did remind me they have spent about $100 billion in R&D in the past 5 years. As for the outlook, remember, Apple did stop giving hard details about the forecast. They do give very detailed color and commentary, and we would look for that for the June outlook quarter on the call.
And one more thing I just wanted to mention. Two comments that Tim Cook made in this statement. He talked about looking forward to an exciting product announcement next week. There's a rumored iPad a thing that's talked about, and he talks about the Worldwide Developers Conference next month. So those are the things we're looking ahead to. It looks like because of reporting, there is some visibility on what we might hear on the iPad. On the AI front, maybe we'll get some more news on that front as well. But we're not getting that stuff today.
The June outlook, I will say, at least the estimates I was seeing, Julie, where the street was looking for June quarter revenue up about 1.5% year over year. And that basically does align with what Luca Maestri told me, saying we expect to grow low single digits. We expect more color, though, coming shortly on that call.
Yeah.
Apple shares jumping on the heels of better than expected second quarter results. And joining us now is Tom Forte, Maxim Group Managing Director and Senior Consumer Internet Analyst. Listen, Tom, initial reaction here. Shares are popping about 4% in the after hours, but let me get your just initial reaction, your response to the results, Tom.
Sure. So I think my initial reaction is the good news was that iPhone sales exceeded expectations. The performance in China exceeded expectations. I think there's still two very significant challenges there. They're over-reliant on the iPhone. It's more than half their revenue. And they're over-reliant on China, which is about 20% of revenue. And the economy there is challenged. But the good news, I think, that you talked about is that it sounds like they're increasing their capital going back to shareholders while potentially ramping their CapEx to perhaps play catch-up in AI. So I think that might be the most encouraging thing I heard so far on the quarter.
First of all, Tom Forte, it's good to see you. It has been a minute since we've had the chance to talk, so I'm happy to have you here. How do you think Apple needs to be deploying that money? You said they need to play catch up. Like, what does that mean exactly? What do they need to be doing?
Okay, so first off, I want to get past the fact that they're not doing a car. So as a Tesla Model 3 owner, I see a million opportunities for Apple to do at least as well, if not better. And then are they truly going to move forward with robots? And are the robots going to be a consumer device? Are we going to have the robots in our homes? Or is it going to be also robots at the assembly plant, which is kind of what Tesla seems to be doing? So, all right, so those things set aside, they need to find an opportunity to be less dependent on the iPhone in the future, given that it's done amazingly well. The product cycle has been wonderfully long, but at some point it's going to come to an end. And I think that's a longer term challenge.
I'm interested, Tom, listen, if you're an Apple investor listening right now, you're already looking at September when Tim Cook takes the stage and introduces those new iPhones. I'm curious, Tom, what do you expect to see there? Are we going to get AI-enabled iPhones, and what kind of upgrade cycle do you think that could kind of generate?
Yeah, so my view is this. Google put it best when they reported and talked about how AI requires such tremendous computing power that it really may be more of a cloud computing story than on a smartphone device story. And Google and Apple essentially have a duopoly when it comes to the mobile operating systems. So I thought that was some very interesting comments by Google. I do think, though, on a near-term basis, when you think about the hype with AI, which reminds me not that long ago of metaverse, and not that long ago before metaverse, blockchain, Apple needs to have a better narrative as it pertains to its AI plans, both to sell its smartphones, the next generation iPhone, and also to sell its stock. So I think that anything Apple could say right now on its AI plans and generative AI could be a boost, even if it won't materially move smartphone sales for the company.
Tom, though, do you think that both the capital return plans announced today and the fact that iPhone sales beat estimates a bit, does that buy them some time at least?
Well, I think that the good news for Apple is it still generates a ton of free cash flow. So the encouraging news is that they're going to use the free cash flow and they're going to buy back more stock. So it's almost beneficial for Apple if the stock stays flat, because then they're able to buy back more stock cheaper. So the good news is that they still generate a ton of free cash flow. They're going to continue to use the cash flow to buy back shares. They slightly increase the dividend. But yes, they'd be beneficial, or it would be beneficial for the stock over the next 12 months to be less dependent on the iPhone, less dependent on China. The wearables number makes me wonder that the Vision Pro wasn't very successful. So I look forward to more details on that on the call.
What about, Tom, a bright spot here, services, $23.87 billion. That was enough to beat the street, up 14% year over year. CFO Luca Maestri just told us that was an all-time record, called it broad-based records in different categories and geographies. Do you see that continuing to be a relative bright spot, Tom?
The growth in services is what drove the stock over the last 3 years, higher margin, higher multiple. However, I think if you backward look at the numbers, or you look at the revenue numbers for hardware, that suggests to me that the hardware sales were down more than 10%. And at some point, if you have a contraction in your installed base, it's going to be more difficult to grow services revenue. So good services revenue in the March quarter, bad hardware revenue in the March quarter. At some point, they need to improve the hardware revenue, or the services revenue will suffer.
So it sounds like you foresee potentially a slowdown in that service revenue.
Absolutely.
Interesting.
Tom, you're still on the sidelines. You're a hold. What would it take to get you more bullish on this name?
It would take more of the risks priced into the stock. So I think we all know that they're over-dependent on the iPhone. They're over-reliant on China from a sales and supply chain standpoint. I'd like to see some of that, more of that risk in the stock, and then I'd be happy to get constructive once again.
Tom, again, great to see you. Thanks so much for joining us.
Thank you.
Coming up, we're taking a look at what to watch on Friday to kickstart your trading day. Of course, we've got the latest jobs report from April. Stay tuned, more Yahoo Finance after this. The takeover battle for Paramount is heating up again. Shares of the company spiking in today's trade after sources confirmed to Yahoo Finance that Sony and Apollo Global have submitted a $26 billion all-cash offer. But what has led Paramount to this buzz of sale negotiations? Yahoo Finance's Alexandra Canal joining us here with the details, a look back and perhaps forward at what's going to happen.
Exactly. There have been many twists and turns leading up to this moment. Of course, we know that Paramount has long been the target of a possible acquisition due to its small size relative to competitors. But this all really started to percolate around 2015, 2016, when the late Sumner Redstone was at the helm. There had been shareholder outcry over the mental capacity of Sumner, whether he was able to lead this company. That eventually led to him stepping down from his chairman position at both CBS and Viacom in 2016. That eventually led to a very nasty legal battle over who would ultimately control this media empire. That was won by Shari Redstone, which is the daughter of Sumner Redstone. So there was a lot of this public drama that played out. And at this time, the Redstones said that they wanted to explore a merger between CBS and Viacom. Then they backed away from that at the end of 2016. As we know, that did happen by 2019. But really pre and post merger, we saw reported interest from telecom companies like AT&T and Verizon, tech companies like Apple and Netflix, who were eyeing Paramount Pictures to try and shore up its streaming services. And then the M&A rumor mill really started to kick into high gear at the end of 2023 when we got the report that Warner Brothers Discovery CEO David Zaslav met with then CEO Bob Bakish. As we know, Bob Bakish is no longer an executive at this company as of this week. And then as those talks eventually fizzled, we saw others come out of the woodwork. Media mogul Byron Allen offering a $30 billion bid for the company, while Comcast discussed a possible streaming joint venture. And then that brings us to today. We really have two offers on the table. Paramount is currently in exclusive negotiations with Skydance Media. Those negotiations, that window expires officially tomorrow. And then sources confirmed with me that Apollo Global, along with Sony, they formally offered a $26 billion all-cash bid for this company. There's no financing that's involved in this, and this would mean that Sony would serve as a majority and controlling shareholder, with Apollo, who is the parent company of Yahoo Finance. Apollo would serve as the minority shareholder. So that's really where we're at today, those two bids. We'll see. I have a feeling that we're going to potentially have those negotiation windows be extended a little bit as the independent board committee that's looking and reviewing all these bids really parses out what all of this could mean for the benefit of all shareholders, not just Shari Redstone, the controlling shareholder. So a lot to keep track of here, but this has been a story that we've been tracking for some time.
And Allie, we were kind of talking off camera here. What are the variables that go into this decision? Because it's not just price, right?
No, it's not just price. And I think a big part of that is the fact that Paramount has a holding company, that we have a controlling shareholder. It's not as simple as this is one company with one executive team and those are the shareholders and that's it. It's a little bit more complicated. There are a lot of different personalities and a lot of different really motivations here too. I mean, Shari Redstone, she had to fight tooth and nail to get this company under her control. So she has been very hesitant to sell. And now we seem to be at this critical juncture where media, I mean, you have linear revenue declining, you have cord cutting escalating, streaming, still significant losses there. So the balance sheet of Paramount isn't great, and perhaps now is the right time to sell. I think it all comes down to what she ultimately wants and who she thinks the best buyer is on the market.
All right, Allie, thank you. Want to watch? Thanks. Time now for To Watch Friday, May 3rd. Starting out on the economy, the monthly jobs report for April is out ahead of the open. Non-farm payroll growth expected to slow compared to March's report. The estimate is for 241,000 jobs added. The unemployment rate, meanwhile, expected to hold steady at 3.8%, and average hourly wages expected to rise 4% from a year ago. But be sure to tune in to the morning brief tomorrow at 8:30 a.m. Eastern for full coverage and analysis.
And moving over to the Federal Reserve, we'll be getting a round of Fed commentary from Presidents Austin Goolsbee and John Williams in the evening. And this comes after yesterday's FOMC decision where the central bank held rates steady. And Fed Chair Jay Powell said it's unlikely that the next monetary policy move will be a hike.
And finally, looking at earnings, Hershey, XPO, and Fubo all reporting tomorrow. Hershey announcing first quarter results before the bell. Analysts expecting a slight boost in sales despite those higher costs and a shorter Easter. The confectionery company dealing with the recent surge in cocoa and sugar prices this quarter due to climate-related issues.
And coming up, we're recapping the numbers from Apple. Stay tuned. More Yahoo Finance is next. Apple shares are jumping in after-hours trading after topping Wall Street expectations for the second quarter, including China sales. Here with more on the key themes from the tech giant's latest results, Yahoo Finance's Dan Howley. Dan, looks like they beat those kind of lowered expectations, I guess.
Yeah. It's. I think the takeaway is it could have been a lot worse, and it wasn't. There are some things worth pointing out here. iPhone revenue was down 10% year over year. Greater China revenue, that was down 8%. Year over year. There were some highlights, though. Services revenue hit $23.87 billion. They said that's an all-time record, up from $20.91 billion. It also beat expectations of $23.28 billion. And Mac also did better than anticipated, $7.45 billion versus $6.79 billion. But iPad was off expectations, and wearables were off expectations, which is interesting. That includes the Apple Watch, the AirPods, and the Vision Pro. So interesting to see there. I think, obviously some of the reaction from Wall Street has to do with the increased dividend to 25 cents per share and the authorization of $110 billion for share repurchases. But, overall, I think the takeaway is, look, yes, iPhone sales were down. That's the most important thing that we talk about. But again, could have been worse. And now it seems as though they're trying to look forward and kind of move past this at this point.
Yeah, I thought it was interesting. CFO Luca Maestri, Dan talked to Yahoo Finance, and I thought some of just looking ahead now, we don't get those kind of detailed guidance in terms of hard numbers, but he gives color and commentary. And what he was telling us just about sales, looking ahead, growing low single digits, he said, which at least the numbers I was seeing, that's basically in line with what the street was looking for. The street was looking for June quarter up like 1.5%. And then AI, we talked so much, Dan, about how much of a focus that is. I did push Luca Maestri on that, and he was willing to say at least, we're making significant investments in Gen AI. Whether we get more color on the call, we'll see. But sort of interesting as we now just kind of lead up to the next big event, which is the software show. I
think that's going to be one of the main things. That's where all the analysts are looking is, and maybe we were talking earlier about whether this is actually going to be something that drives sales. We'll see, but I think for Wall Street, it's more of, are they adding it? It's not even at this point, is it going to do anything? It's just,
or do people actually want it?
Right, exactly. It's, well, did they say it? Did you say that you have it in your device? Because if you didn't, well then, I don't know what to tell you. We're not interested. Right. But the minute they probably come out and say, and they probably won't even say generative AI, right? They don't like to name the technologies themselves.
And it could be, Dan, they could, Cook could take the stage and say, introduce AI features and tools, and maybe it actually doesn't spur the big cycle in 25. Maybe it just, like so much else Apple does, people do seem to want it, but maybe it's a 2026 thing.
Yeah, look, I think the thing to look at is the Apple Watch originally poo-pooed.
Yeah.
It's everywhere now. AirPods originally poo-pooed. They're everywhere now. Maybe I'm not saying Gen AI will be poo-pooed on the iPhone, but if there is a muted reaction to it, it could still see that big explosion.
Right, the longer cycle. All right, thanks so much, Dan. Appreciate it. Let's take a look at what else is trending after hours. Amgen shares, let's check on those. They're up 10% after the biotechnology company's revenue jumped 22% in the first quarter. It said sales across 10 of its products grew at a double-digit rate, though it did swing to a loss during the 3-month period. That loss driven by expenses from its acquisition of Horizon Therapeutics.
And shares of DraftKings on the rise here as revenue and adjusted EPS for the first quarter topping estimates. The sports betting company boosted its full-year revenue forecast on the back of the strong results, citing an improved outlook on customer acquisition and engagement for the rest of 2024. Monthly unique payers jumped more than 20% from a year prior. During the quarter, the CEO of DraftKings will join Catalyst tomorrow at 10 a.m. Eastern.
And shares of Live Nation edging higher after first quarter revenue there beat expectations. Revenue coming in at $3.8 billion, the estimate for $3.26 billion. The company reporting a loss of 53 cents a share. And the company CEO saying in the release that first quarter results do demonstrate that live events remain a priority for fans around the world. Certainly, there'll be some questions on that conference call about the sort of inquiries into ticketing, into how it runs things. It owns Ticketmaster, of course.
Yep.
That should be interesting. That'll do it for today's Yahoo Finance Live. Be sure to come back tomorrow at 3 p.m. Eastern for all of your coverage leading up to and after the closing bell.